So it's December the 23rd, just before Christmas, and Santa has come early for equity holders in that the markets have been on an extraordinary run over the last couple of weeks. But before we go through all the details, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Well, it's been a busy couple of weeks, sadly, as we have a lot of data to get through. 2 weeks of macroeconomic data, and the data reporting schedule has been accelerated to get it all out before Christmas. So we've got a lot to get through. But first of all, the news. So first of all, scientists have made a cyborg by combining a computer chip with brain-like tissue. I'll show you the graphic in a second. Jerome Powell gave a speech in which he suggested that the Fed could cut rates by 75 basis points in 2024, and that the Fed will need to start cutting rates way before inflation hits the 2% target in order to avoid the economy slowing too much. That has sparked off a rally in just about all financial assets, with US equities doing particularly well. The ECB met and held rates. The Bank of England met and held rates, but warned that inflation risks remained skewed to the upside. As I'll show you in a second, that actually UK inflation came in well below expectations, and actually UK inflation is coming down very quickly, and actually the risks appear to be to the downside. COP28 ended with an agreement to phase out fossil fuel use, and the US has actually agreed to start phasing out coal. But the 1.5 degree temperature target is likely to be missed. And as you'll see from the data, inflation in the UK, US, and EU all came in soft. Now, the other news was the EU met to agree a new budget deal. The Germans in particular had been unhappy with the previous deal and argued it was not tough enough. So they have agreed a new, tougher debt reduction plan. Reminder: members of the Eurozone are subject to fiscal rules that require member states to have debt to GDP of less than 60% and fiscal deficits lower than 3% per annum. But post-COVID, almost all the states in Europe are well above the 60%. So the new rules will aim to get sovereign debts back towards the 60% target. And the EU will draw up 4-year state spending plans for each member state to ensure that their debt is on a declining path. If countries commit to various growth enhancement measures, then that pathway can be extended to 7 years rather than 4, meaning that the budget reductions will be less severe. Countries with debt to GDP ratios in excess of 90% must commit to reducing their debt burden by 1% per annum. Those in excess of 60% by 0.5% per annum. Now, breach of the rules should, in theory, lead to sanctions and the freezing of payments from the EU. But the whole reason the last budget deals did not work is that the financial sanctions have never been applied. And if we believe that this budget deal is going to be effective, then at some stage, the EU will have to get out the big stick and actually start punishing countries that break the rules. But the net effect of this budget deal will be to constrain state spending in the Eurozone. And previously, the Eurozone was stuck in a low growth, low inflation equilibrium. And going forwards, we know currently that the EU is stuck in recession, and countries such as Germany are having to cut their fiscal deficit in order to balance the budget, which means the EU will find it more difficult to recover from recession. It will have to use much more monetary policy than fiscal policy, which implies that EU interest rates are going to come down hard when inflation is under control. And frankly, inflation looks like it's rapidly coming under control. Now, this is the cyborg chip that scientists managed to make by combining this organoid brain type tissue with a computer chip. And the results showed it could quickly pick up pattern recognitions and maths predictions. Frightening. The future is already here. The Fed met and kept interest rates flat, but reminder, interest rates have risen very, very quickly over the last 2 years, and to actually remarkably little effect on financial markets. This is the UK, also unchanged at 5.25%. UK GDP for Q3 was revised down to minus 0.1% this week. And in Q2, GDP growth was 0. So unless we see recovery in growth in Q4, then it looks like the UK may already be in a technical recession. Reminder, GDP growth in October was minus 0.3%. So the fourth quarter has got off to a poor start. EU interest rates are unchanged at 4.5%. The bond market liked Jerome Powell's speech, and bond yields dropped very sharply after he announced that he expected to be cutting interest rates in 2024 by around 75 basis points. The whole bond market rallied. We'll show you the data later. And there has been a big change in expectations for the Fed funds rate over the past 3 months. So the blue bars are as of end of September, the white bars now. So you can see there's been a huge change in the expected number of cuts over the last 3 months. Now expecting a total of 1.5% of rate cuts by January 2025. So this is the Fed's interest rate expectations, and they are expecting rates to fall by around 75 basis points next year and for them to average 2.5% long term. You can see from the previous chart, the market is expecting the Fed to cut by more than that. Okay, and warning, we've got a lot of data to get through, particularly for the UK and the US, so I'll try and push through it. So first of all, the UK. Well, great news on inflation. Inflation for November was expected at 0.1%. It came in at minus 0.2%. And that meant CPI came in at 3.9%, well down on October and rapidly heading towards the 2% target. Inflation in the UK is coming down much faster than anyone expected. Core, so excluding food and energy prices, was even better, minus 0.3% compared to expectations of plus 0.2%, well down on October. So the UK suffered from deflation in November, and that's going to rapidly bring inflation down if it persists. Core CPI still high at 5.1% year on year, but that number is well below expectations. And if we return to the core monthly numbers, if you add up the monthly core CPI numbers from the last 6 months, you get to plus 1.1%, which means core CPI over the last 6 months is annualizing at around 2.2, 2.3%. So UK inflation actually is heading quite quickly towards the Bank of England's 2% target. RPI year on year came in at 5.3%, well below expectations and well down on October. Input producer price inflation was negative at minus 0.3%, although that was actually worse than expectations. Expectations were that it would fall by 0.8%. Year on year remains negative. So that should mean that producers are still having negative year-on-year input prices, and they should then pass on that drop in prices to consumers. Output prices fell 0.1% in November, and that was actually slightly worse than expectations of minus 0.2%. Output prices year on year also fell, although not as much as expectations. If we look at the contributions to the fall in UK CPI over the last month, you'll see that the main contributor to the drop was transport due to the fall in oil prices, but the deflation was extremely broad-based. And the great news was that price of food and beverages fell, alcohol and tobacco, pretty much everything actually, and most remarkable, recreation and culture, which has been a persistent cause of inflation over the last year. And here you can see that services inflation does remain elevated, but goods inflation has fallen very rapidly. And recreation and culture prices are finally starting to fall. They have been a very persistent source of inflation over the last year. This is food and alcoholic beverages. That's continuing to fall. The good news is that if UK inflation averages less than 0.3% month on month in the coming 6 months, then the Bank of England will hit its 2% target. That is great news. And the most recent data suggests that it will. Moving on to the PMIs, reminder, these are surveys of different industries and give a snapshot of how confident those industries are feeling and doing. And in December, UK manufacturing came in at 46.4 in December, which was worse than November and below expectations. The expectations had been for a small bounce. So any number below 50 indicates contraction, and the recession in UK manufacturing got worse in December, having been on a bit of a recovery prior to that. Services, however, bounced. 52.7 shows that services in the UK are continuing to expand, although not at a fast pace. Let me read this out. The S&P Global SIPS UK Services PMI rose to 53.7 in December from 50.9 the previous month, above expectation of 51, marking the second consecutive expansion of the British services sector and outperforming the contractions in Eurozone members. It was the fastest expansion since May, matching the fresh upturn in new orders, with survey respondents reporting tentative signs of revival in consumer demand, particularly in financial services and technology. So, the UK services sector is proving resilient, and as a result, the composite was 51.7. So, the UK economy appears to have recovered from its lows in October and is resilient. So some employment numbers. So UK unemployment rate was flat in October at 4.2%, which was better than expectations. Expectations had been for a rise. Weekly earnings are finally starting to drop. In October, year on year, average weekly earnings, including bonuses, came in at 7.2%, well down on September, although the September number was revised up. Excluding bonuses, it came to 7.3%. Again, well down on September and below expectations, but still far too high for the Bank of England to be happy. The extraordinary rise in public sector pay appears to now have passed, but wage rises in both private and public sectors remain far too high. In November, the claimant count rose by 16,000, up on October and above expectations, but the October number was halved. So the UK economy, frankly, doesn't seem to be doing that badly, and there's no sign of a sustained rise in unemployment. You'll see that the 16,000 rise in unemployment in November compares very favorably with 2019, when the economy was doing okay. Job vacancies, however, in Q3 continued to fall. So the UK labour market is slowing, but it's slowing slowly. And if you look at the decline in jobs vacancies by industry, it was broad-based. Essentially, every industry except for mining and quarrying showed a drop in job vacancies. UK employment continued to rise, so a further 210,000 people found jobs in Q3. The only sectors to lose jobs were construction and power generation. Bad news is that the rise in interest rates is causing a fall in investment, which was down sharply, down 3.2% quarter on quarter in Q3. The HMRC payroll count fell in November, and that was well down in October and below expectations. But again, not a terrible number. We then had GDP numbers for October. They showed the UK economy fell by 0.3% month on month, well down on September and below expectations. But the PMIs show that the UK economy has actually been doing better in November and December. If that is the case, then it's possible the UK may escape a technical recession. And the contraction in activity in October was broad-based, with services, manufacturing, and construction all contracting. The biggest contributor to the fall in GDP was the information and communications sector, which includes e-commerce. Year on year, GDP rose just 0.3% in October, below expectations, and well down on September. So the UK economy is stagnating. We also had final numbers for the quarterly GDP estimates, and they were revised down. So in Q3, the ONS now estimates that the UK economy shrank by minus 0.1%. And they also revised down the Q2 number to 0%. So the UK economy has now not grown. Indeed, it's shrunk during the last 6 months. Year on year, the quarterly numbers again portray a UK economy that is stagnating and growing just 0.3% year on year. Good news. In November, UK retail sales grew by 1.3%, which was much better than expectations and well up on October. Reminder that the Black Friday sales were in November and the big price cuts seemed to have incentivized people to open their wallets. Retailers are very cautious about the new year, with commentary suggesting that consumers have brought forward their purchases to the pre-Christmas period and and retailers are expecting them to cut back in the new year, which would obviously mean that retail sales fell more than expected in early 2024. Year on year, retail sales grew 0.1% in nominal terms in the year to November. That was much better than expectations, but the reality is we've had a lot of inflation, and nominal sales growth of 0.1% equates to a drop in real retail volumes. Industrial production in October was poor, down minus 0.8%, well below expectations and well below September. And that's contributed to the minus 0.3% drop in UK GDP in October. Year on year, industrial production was 0.4%, well down on expectations and September. Manufacturing production also had a very bad month, down 1.1% in October, and it has now been falling for the last 4 months. Manufacturing production year on year is 0.8%, well below expectations and below September. Construction output also missed expectations, coming in at 1.1% in the year to October, well down on September and below expectations. The CBI Industrial Trends Orders Index came in at minus 23 in October, which was a bounce from September, but still in contraction territory and slightly below expectations. The Royal Institute of Chartered Surveyors house price balance actually showed a recovery at minus 43. So the housing market is still shrinking, but the pace at which the prices are falling may be ameliorating. A lower proportion of chartered surveyors are reporting falling house prices. The UK trade balance missed expectations. The expectations were that it would actually rise sharply. It fell in October to minus 4.5 billion. Good news is that consumer confidence is also rising. It's not great, but it's well up from its lows of earlier in the year. Now, we reported earlier that the retail sales in November were very strong, but the CBI Distributed Trade Survey for December showed a sharp drop in expectations. I'm going to read this out. The Confederation of British Industries monthly retail sales balance worsened to minus 32 in December from minus 11 in November, well below market expectations of minus 12. Sales volume was seen as below average, minus 25% from minus 16% in November. And retailers cut back on orders placed upon suppliers at the fastest rate since May 2020, minus 54% from minus 22%. These are big numbers. The retail sector ended 2023 on a glum note, with the ongoing downturn in sales volumes deepening during the crucial holiday trading period. Looking ahead, retailers are bracing themselves for New Year's chill, as sales are set to fall at an even quicker pace next month. Strained household finances and higher interest rates continue to take a toll on consumer spending, suggesting the retailers will have to navigate a tough demand environment in the months to come. So, we saw a big bounce in retail sales in November, but surveys of retailers suggest that essentially consumers bought a lot during the Black Friday sales and have since cut back. So We know consumer confidence is improving, and actually services PMIs are improving, which include retailers. We'll just have to see what the GDP numbers are like when they come out for December, but it seems that consumers may have cut back in December from November. The public sector borrowing requirement in November was better than in October, but still worse than expectations. And you can see that the UK has not got its fiscal house in order following the pandemic. Good news for the Bank of England is consumer inflation expectations continue to fall. Bad news for the UK is that Rishi Sunak had promised to cut UK national debt as a percentage of GDP over the course of the year, and he's absolutely failed at that. UK national debt stood at 97.5% of GDP at the end of November, compared to 95.9% at the start of the year. So national debt has actually increased by 1.6% over the course of the year. UK summary. Well, it's likely the UK is already in a shallow recession, given the revisions to Q3 GDP data, which show the economy shrank 0.1% during that quarter. And month-on-month numbers for October shall show that the economy fell a further 0.3%. So, unless we see a bounce in November and December activity, it looks like we are already in a technical recession. Now, the PMIs show the UK economy actually doing better in November, December, but you've seen retailers are reporting that consumers have cut back again in December. So, conflicting data. The great news is inflation is falling much faster than expectations and is likely to keep on falling. Wage inflation remains far too high, but the most recent data, 3-month annualized, suggests that wage inflation is also coming down to around 4.2%. The jobs market continues to cool. And onto the EU, and actually we don't have that much EU data. So the manufacturing PMI was dreadful still, 44.2, unchanged from November and well below expectations. The services PMI disappointed, coming at 48.1, down on November and below expectations. So unlike in the UK, where services are strengthening, in the EU, the service sector is weakening. That meant the composite also fell. So the EU economy, according to the PMIs, remains in recession. Good news is that the ZEW Economic Sentiment Index, which shows the expectations of economists, bounced strongly in December. So economists are increasingly confident about the outlook for the EU economy. Why? I'm not sure, because the PMIs are deteriorating. Inflation certainly is coming down. But the EU appears to be stuck in a shallow recession with no immediate signs of recovery. Industrial output in October missed expectations, shrinking 0.7% month on month. Year on year, down 6.6%. Not a good number, well below expectations. Construction output year on year was minus 0.7% in October, below expectations, but the good news is the September numbers were revised up sharply from minus 0.3% to 0.7%. EU consumer confidence also shows sign of recovery to minus 15. Reminder, EU citizens are always miserable. They never get up to 0, which means neutral. They're feeling just about okay. Throughout the history of this chart, they've always felt miserable. And minus 15 is a bad number, but not totally unprecedented. So EU citizens miserable, but feeling a little less miserable. Bad news, though, is the Citigroup Economic Surprise Index has turned back down. So the latest data suggests that the EU economy is underperforming expectations still. So in summary, the EU appears to be in a shallow recession that is likely to get worse as the lagged effects of the sharp rise in interest rates continue to impact the economy. And onto the US. Now, we've got a lot of US data, so I'll try and push through this. So the PMIs, well, the manufacturing PMI showed a drop in December to 48.2, i.e. mild contraction, and that was below expectations and below November. Services, however, bounced. Now, 51.3 is not a great number in compared to the average, but it shows that the services sector is still expanding and that the expansion is strengthening compared to the previous month. And I'm going to read this out. The S&P Global US Services PMI rose to 51.3 in December from 50.8 in November, beating expectations and extending the period of resilience in the US services sector. The result marked the 11th consecutive period of expansion and at the fastest pace since July, with respondents confirming an increase in new orders due to greater advertising spending, upselling of additional service lines to existing clients, and looser financial conditions due to the sharp decline in treasury yields. Still, firms noted that pressure on the disposable income for overseas clients limited growth in the period. Additionally, US service providers logged the sharpest level of employment growth since June, supported by the anticipation of strong business in the coming months. On the price front, higher wage bills continue to burden input costs for the sector, but output charge inflation cooled to its second lowest level in 10 months. So the danger there is that the service sector has added employees in the anticipation of better conditions and better orders in the coming months. And if those don't materialize, then they could lose them again. And as a result, the composite also strengthened in December to 51. So the US economy appears to be resilient still and little sign of an imminent recession. We had the non-farm payrolls data for November, and once again, it was strong, beating expectations and up on October. The US continues to create jobs. As a result, the unemployment rate actually fell quite sharply to 3.7% in November from 3.9% in October, and that's well below expectations. So the US jobs market remains tight, and that will not please the Fed. Average hourly earnings also bounced up 0.4% month on month in November, higher than expectations and up on October. Wage pressures remain. Year on year, average hourly earnings were unchanged at 4%, in line with expectations. Participation rate bounced up to 62.8, which was better than expected. Hours worked also bounced up to 34.4, above expectations and above October. UK economy seems to be doing just fine, frankly. Now, turning to the non-farm payrolls. The non-farm payrolls is actually not as strong as it appears because there were 50,000 striking Hollywood and United Auto workers returning to work in November, and that flattered the job creation. And if we look at job creation by industry, you'll see a lot of the new jobs were created in education and healthcare and government. Private sector job creation was much weaker. You can also see that hourly pay is at 4% year on year, but the trend is definitely down. So wage inflation is coming under control. So this chart shows that despite the headline 199,000 job growth, actually job growth in the private sector is weakening. Most of the job growth was in education and health, which is non-cyclical. And if you look at the diffusion index, so the number of industries reporting increasing employment versus minus the ones reporting falling employment, you see that that is falling as well. So the number of sectors still expanding and creating jobs is shrinking. Permanent job losses are up 23% from their lows. And this chart just reiterates that the breadth of jobs growth is falling. And the manufacturing sector is in recession and jobs growth is negative. Temporary help services employment continues to decline. Reminder that is a leading indicator because the first employees that companies let go are temps. But the rate at which unemployed people are finding new jobs looks about normal. So although the labor market is loosening, it is only loosening to average levels, not recessionary ones yet. And the job loss rate remains low, so companies are not firing. According to Indeed, wage growth actually picked up a bit in November, which will worry the Fed. And although we are seeing a drop in job openings, there are still 1.34 job openings per unemployed person. So the labor market is tight. But a record number of Americans have 2 jobs in order to make ends meet. So that is not a sign of consumer health. So overall, I think we can say that the US labor market remains tight, but that private sector jobs creation is not as strong as the headlines would suggest. Moving on to inflation. So this is US CPI month on month. Actually, in November, it was slightly worse than expectations, coming in at plus 0.1%, which is still a great number. Year on year, 3.1%, in line with expectations. Core CPI, November, came in line at 0.3%. Year on year at 4%. Now, we look at those month-on-month numbers and we add them up over the last 6 months, then we get to about 1.4%. So annualized core CPI is coming in at around 2.83%. So the Fed will think that there's still some work to be done before core CPI returns sustainably to the 2% target. But, of course, the CPI numbers contain owner's equivalent rent, which is a lagging indicator. And if you exclude shelter, then CPI year on year is only 1.3%. So the idiosyncratic way in which the US accounts for housing costs through OER means that inflation, as measured by the CPI, is higher than it should be, and therefore monetary policy is likely tighter than it needs to be to get inflation back to 2%. So the 3.1% annual inflation reported for the US in November, 2.1% of that was from housing. I'm aware that the numbers in this and the last chart slightly contradict each other, but housing in the US is definitely a big chunk of reported inflation. So owner's equivalent rent is currently 6.7% year on year. And that is why inflation CPI is higher than it should be. If instead of using owner's equivalent rent, we use real-time rents, then core CPI is negative year on year, and core PCE inflation, so personal consumption expenditure inflation, is actually below 2%. So real US inflation is likely lower than the official statistics because of the way you're measuring housing costs. Trimmed mean inflation is still too high, but is coming down. Sticky price inflation is also falling, but again, remains high. Okay, looking at PCE inflation, which is the Fed's preferred measure, well, in November, that came in at minus 0.1%, i.e. deflation, better than October, below expectations. Year on year, 2.6%, rapidly approaching the Fed's 2% target, and the October number was revised down. Core PCE came in at 0.1%, again below expectations. Again, the October number was revised down. Core PCE inflation, 3.2% year on year. As we've just seen, if you use real-time rents rather than owner equivalent rents, then core PCE inflation is around 2%. Producer prices were flat in November, better than expectations, although up on October, year on year, 0.9%. So input price inflation is positive, but very weak. Core PPI, still flat in November and 2% year on year. Export prices fell 0.9% in November, which was slightly better than expectations, but another month of falling export prices. And that means year on year, export prices were minus 5.2% in November. I strongly suspect that's all to do with oil prices. Import prices also fell 0.4% in November and are down 1.4% year to date. Very little signs of any inflationary pressures. As a result, the New York Fed's consumer inflation expectations are showing a very welcome decline to 3.4% in November, below October, well below expectations, but the Fed will want to see that number coming much closer to 2%, although you notice even when the US had very little inflation in the 2010s, inflation expectations never reached 2%. We then had final Q3 GDP numbers, and they were revised down from a blistering hot 5.2% to a still astonishing 4.9%. The US economy has absolutely outperformed everyone's expectations this year, particularly mine. PCE inflation, quarter-on-quarter annualized, Q3 came in at 2.6%, and that was revised down from 2.8%, so that's great. Core, 2%, again revised down and coming down very quickly. We also had the US Michigan surveys of consumers, and they were generally positive, showing that US consumers were feeling better about life, but still not great. So bounced to 69.7 in December. Much better than expectations and better than November, but still not a great number. Current conditions also bounced to 73.3, better than expectations, up on November. Inflation expectations dropped very sharply to 3.1%. Still too high, but a sharp drop from November and well below expectations. The fall in oil prices, I think, has a lot to do with that. 5-year inflation expectations also fell to 2.9%. And within the Michigan surveys, you can see that consumers are actually increasingly positive about buying large household durables, but still reluctant to buy either vehicles or houses. So when you think about the relative prices of those items, you can see a strong dispersion. So household durables, which cost between, let's say, $300 to $1,000, consumers are feeling more confident about making that sort of size of purchase, but they're reluctant to buy more expensive cars or even more expensive houses. Durable goods orders in November show a very strong bounce from October, coming in at 5.4% month on month, well above expectations, and recovering from the contraction in October. Durable goods orders, excluding transport, also were positive, but much less positive. The Philadelphia Fed Manufacturing Index showed a sharp drop in December from November, as did the New York Fed's Empire State Manufacturing Index, which showed a very sharp drop, well below expectations. I'm going to read this out. The New York Empire State Manufacturing Index shrank to minus 14.5 in December 2023, the lowest reading in 4 months, signaling that business activity in New York declined. It compares with a reading of plus 9.1 in November and forecasts of 2. New orders fell for the third consecutive month. Shipments also declined. At the same time, unfilled orders continued to shrink significantly. Delivery time shortened at the fastest pace since before the pandemic, and inventories moved lower. Employment declined modestly, and the average work week edged down. So the markets are currently off to the races on the basis of anticipated interest rate cuts in 2024, but we're not out of the woods yet. The US manufacturing sector seems to have suffered a bit of a setback in December. Reminder, the PMIs show that the services sector bounced and expanded in December. The Conference Board leading economic indicator continued to do poorly in November, missing expectations. And if you look at the components, you'll see that despite the S&P 500 having a bouncing in November, the drop in manufacturing new orders was the main cause of the continued fall in the leading economic index, which continues to forecast a recession. Industrial production in November was 0.2%, better than October, but still not great. Year on year, minus 0.44%. Manufacturing production, 0.3% in November, again better than October, but still missing expectations and not great. And it was minus 0.8% year on year, again missing expectations. The housing market index bounced slightly in December, so house builders are feeling a bit more positive, but not great. Good news was that in November, retail sales bounced back, growing 0.3%, in part because of Black Friday, I assume. And much better than expectations. Year on year, growth was 4.1%. Again, much better than expectations. New home sales, though, in November showed a strong drop, running at an annualized 590,000 a year, well below expectations and well below October. And that is despite rising consumer confidence and falling mortgage rates. Building permits also fell, but that is a good number. Housing starts rose 15% month on month. So new housing sales fell by 15% month on month in October, but house builders started far more homes. Mystifying. Johnson Red Book retail sales stabilized at around 3.6% annualized annual nominal growth, and mortgage rates have started to fall in line with bond yields, which should be good for the housing market. But they're still a long way up from a couple of years ago and from 10 years ago. So as a result, there has been only a very limited pickup in mortgage market activity, and that is running at, the index is running at 192 now, compared to 1,000 in 2021. Initial jobless claims show no sign of rising. Continuing jobless claims are stable. There is no sign of a sustained rise in unemployment so far. The Dallas Fed's weekly GDP estimate shows that they think the US economy is expanding at around 2.4% currently, and that's up. The Citigroup Economic Surprise Index, having fallen sharply over the last month, actually appears to have stabilized and bounced. So the US economy continues to beat expectations. And the Atlanta Fed GDP Now estimate for Q4 has shown a sharp rise and is now at 2.7%. So in summary, the PMIs showed the US manufacturing sector is in recession, but the services sector, though weak, is still expanding, and that expansion is strengthening. Overall, the pictures they portray is of a weaker economy that is avoiding recession and not deteriorating. The jobs report again showed an economy which was resilient and continuing to create jobs, but breadth was deteriorating, and most of the jobs were being created by the government and health and education. Great news is that inflation is falling fast and is likely to continue doing so. If we substitute real-time rental data for OER, then US inflation is at or below the 2% target. So we continue to expect the US economy to slow as the delayed effects of the rise in interest rates begins to impact the economy. But so far, the US economy has been resilient because consumers and corporations locked in low interest rate debt during the pandemic, and that has yet to be refinanced. So actually, they haven't experienced much of the rise in interest rates. There has been a positive US fiscal impulse as the US budget deficit actually grew quite substantially last year, as we have covered previously. And construction activity has been very strong due to manufacturing investment incentivized by the CHIPS and IRA Acts. And finally, US consumers have not consumed all their excess savings from the pandemic, although they're forecast to have done so by the end of Q1. So, of those, the last three can be expected to fade in the coming year. So that suggests that the US economy may struggle over the coming quarters, but we have been saying that for quite a long time now. And I would also say that animal spirits are certainly very strong, as evidenced by the stock market, and a lot of the economy and investment, new investment, depends on confidence. And even if the fundamentals look poor, if people are confident about the future, then they will continue to invest, and in doing so, they will actually ensure the economy remains strong. Finally, on to China. Chinese inflation massively missed expectations, coming in at minus 0.5%. So that meant China has slipped back into deflation year on year. Prices fell 0.5% in the year to November. That is not the sign of a strong economy. That suggests supply exceeds demand, and Hence, producers are having to cut prices to sell their goods. The only times previously that China has had deflation was during global recessions. Suggests not just domestic but also international demand is weak. Producer price inflation missed expectations, coming in minus 0.3% year on year in November. Loan growth continues to drift gradually lower. In October, it was 10.8% below expectations and below September. House prices, according to the official numbers, fell by minus 0.2% year on year in November. But the FT is reporting that from its interviews with the state agents in Beijing, actual house prices have fallen between 10 and 30% from their peak in 2021. Now, that is incompatible with the official statistics. And that suggests that, A, we should be very wary of the official statistics in China, and B, that the Chinese economy is not doing very well. Certainly, the housing market continues to decline. Industrial production, according to the official statistics, bounced sharply in November, up 6.6% year on year, well ahead of expectations, and retail sales also surged strongly to up 10.1% year on year, although below expectations. The Chinese are not repeating their earlier game of trying to boost the economy through infrastructure investment, and actually fixed asset investment came in below expectations in November. The unemployment rate, if you believe it, was unchanged at 5%. And there's further evidence that the Chinese economy is not doing very well. Q3 was the first time in 25 years that China had negative foreign direct investment. So there's a net outflow of investment from China. If you look at the growth in Chinese private sector debt, it is growing very quickly and is now at 307% of GDP as of Q1. And historically, when a country's private sector debt has grown this quickly, it implies a lot of malinvestment, and eventually that leads to a financial and an economic crisis. Watch this space. That could have been said, of course, at any stage along this path, but that path is unsustainable. At some stage, China will have to stop piling on debt, and if its economy is dependent on continued growth in debt, then the economy is going to have to slow. Returning to the Chinese property market, you see there's very little sign of recovery, either in new construction, which is the chart on the left, or floor space sold, which is actually continuing to decline. So in summary, it's very difficult to know what to believe about the Chinese economy. According to the official statistics, the Chinese economy appears to be strengthening. However, it's also in deflation, which is not a sign of a healthy economy. And official data shows house prices falling by 0.2% year on year, but the FT is reporting they're down 10 to 30% since 2021. Who to believe? Okay, on to one chart. So this chart shows on the y-axis core CPI year on year, and on the x-axis the unemployment rate. And generally, the Fed cuts rates when the unemployment rate is higher than core CPI. So the blue diamonds are when the Fed started cutting rates. Previously, they've cut rates when unemployment rate is below core CPI. The only times when they've cut rates despite core CPI being higher than the unemployment rate is during a recession. So that means that if the Fed is going to be consistent with its historic behavior, then in order to start cutting rates, you're either going to need to see a rise in the unemployment rate or continued falls in CPI. But the market's now pricing in 100 basis points of Fed cuts in 2024, and that seems optimistic unless you get further falls in core CPI. But to be fair, we should get further falls in CPI because of the continued decline in OER, as we discussed earlier, or we get a recession. And as we discussed earlier, the market is pricing in more rate cuts than the Fed themselves are. Okay, and on to inflation watch. Well, we've had lots of data over the past 2 weeks. The next Bank of England meeting is on the 1st of February. The FOMC meets on the 30th to 31st of January, and the ECB is the first one to meet on the 25th of January. So now UK CPI inflation is at 3.9% and falling rapidly. Core CPI, way too high still at 5.1%, RPI at 5.3%. US inflation is at 3.0%, core CPI at 4%. EU inflation is at 2.4%. Core at 3.6%. Everywhere, inflation is rapidly falling towards target. This is interesting if you're a US citizen. It shows that inflation, actual inflation, has fallen much faster than consumers expected, but particularly more than Republicans expected. Republicans have been very pessimistic and believing that actually inflation was going to head off to the races. So Republicans believe that inflation now would be around 6%. Turning to the EU, the official projections for EU inflation are the green dotted line. All the private sector forecasters are much more optimistic. And so, as inflation data comes in, you would hope the ECB's very conservative inflation expectations will be revised lower, and we expect the ECB to be the first central bank to start cutting rates. US trueflation is at 2.76% and appears to be falling again. And US food price inflation, having peaked at 13.5%, is now running at 1.7% and falling. The bad news is that the National Federation of Independent Businesses survey shows that US small businesses are intending to raise salaries once again. So, although inflation in the US is coming down, the danger is that because the labor market remains tight, those gains, those falls in inflation are not sustainable. So the Fed will need to see a slackening labor market before it cuts rates. And the market has not priced that in. The market has not priced in further slowdowns in the US economy. Good news is that wages in the US are growing faster than inflation, but they are both falling. So wage inflation currently is on a downward path. UK inflation is at 3.1% and rapidly converging with the US. You'll see that at the start of this year, Trueflation calculated that the UK inflation was running at 22%. It's now 3.1%. There's been extraordinary disinflation in the UK, much better than anyone has predicted. In some way, inflation is falling everywhere. So in the UK and the EU, the economies currently appear to be in a shallow recession, and they are unlikely to recover while central banks keep their interest rates very high. The danger is they keep interest rates higher for longer than is necessary to tame inflation, because inflation actually already looks like it's rapidly coming under control. In the US, although inflation is falling and looks like it may already be at the 2% target, the tight labor markets mean that wage inflation could well make a comeback, and the Fed will need to see some slack in the labor market before it starts cutting rates. On to recession watch. Credit conditions for US small companies continue to tighten. Corporate bankruptcies in most countries are rising, and in a few countries, they're higher than during the Great Financial Crisis. So Denmark, they're much higher, 40% higher than in the 2008-2009 average. In UK, they are over 10% higher. In the US, however, they're not. They're lower, substantially lower than in the Great Financial Crisis. The US fiscal deficit, as we discussed earlier, added moderately to growth in 2024, but going forward, it's going to be a drag as the US fiscal deficit does not expand in 2024. CapEx expenditure will also be a drag on the US economy in 2024, and non-residential fixed investment also appears to be slowing. And even though real interest rates in the economy have fallen recently, they still remain very high. This is the proxy funds rate is calculated by San Francisco Fed and shows what actual interest rates faced by consumers and businesses are like in the US, as opposed to the Fed funds rate, which is in blue. And so you see it's peaked, but it's still shown an absolutely extraordinary rise over the last 2 years. So compared to that, interest rates remain very restrictive. In summary, the UK, EU, and China are likely to be already in recession. The US has remained resilient, but the economic fundamentals continue to suggest it should slow. And on to soft landing watch. Well, everyone's cutting their probability of a recession in the next 12 months. It's now down to 50-50 from as much as 65% earlier in the year. Loan delinquency rates are near to an all-time low. The SARM rule, which tries to predict a recession based on rising unemployment rates, is no longer showing an elevated risk of recession. Gasoline prices have been falling, and that should boost disposable income in the near term. This is confusing because the right-hand axis is inverted. So the blue line shows that retail gasoline prices have fallen very sharply over the last year, and that should support disposable income. This shows consensus GDP estimates for the US, and throughout 2022 and 2023, they have been way too low. The US economy has been extraordinarily resilient. Financial conditions are easing, and actually they're the easiest they've been since early 2022. And corporate credit spreads, again, falling. So the bond market is charging a low spread over treasuries to lend to US corporations, and also signaling that it expects no distress in US corporate bonds. Bottom line, no sign of a hard landing anywhere. We continue to expect the world economy to slow in 2024, but the US has totally defied expectations, and the latest real-time GDP estimates show that it's doing just fine. Thank you very much. And one of the reasons the US economy has been doing just fine is the strong construction sector. So let's have a look at it. All this data is from Yardeni Research. So this chart shows that total construction expenditure in nominal terms continued to rise throughout the year despite very high interest rates. And that is not what you would expect. The blue line is real expenditure, and it fell earlier in the year, as you might expect, but it has since recovered. And this chart shows residential construction in nominal terms. And again, it's actually been growing over the last 6 months. So construction market appears to have bottomed despite the very high interest rates and record low housing affordability. Non-residential structures in real terms are the main cause for the resilience of the construction market this year. That is a big rise. And looking into that rise in non-residential construction, it's clear the majority of it is from manufacturing, in particular semiconductors and tech, which is reshoring after the experience of supply chain difficulties during the pandemic. But you'll notice that growth appears to be stalling, and that would mean that the impulse from non-residential construction is also topping out. And if it falls back down to more normal levels in 2024, that would mean that the impulse turns negative and the effect on GDP would be negative. Amazingly, given the problems we know in the office commercial real estate, as everyone now works from home and the prices of existing offices have collapsed, actually, office construction has been amazingly resilient. In dollar terms, investment in manufacturing structures has trebled in 3 years. Most of that is chips, batteries, and electronic. Government investment in infrastructure has also been strong, particularly in highways and streets, but also in education. Construction employment has therefore continued to rise. Now, normally the way a recession works is that higher interest rates mean that houses become unaffordable, and also long-term projects such as building offices become very expensive because the financing costs have gone up, and therefore that reduces investment, leading to falls in construction activity, leading to falls in construction employment. And as those construction employees have to cut back because they're no longer in a job, so that reduces demand throughout the economy and leads to a cascade of job losses and further slowdown in the economy. Well, this time it hasn't happened. And a lot of that can be put down to the strength of manufacturing construction. But even employment in residential construction has continued to grow. Amazing. Reminder that US interest rates have risen incredibly quickly, and US mortgage rates have risen faster still. Bottom line, there's no sign that the big rise in interest rates has yet caused a slowdown in construction activity. Private residential construction activity actually appears to be rising again. Manufacturing construction activity has trebled in the last 3 years and has not yet peaked. So the usual recession dynamics just haven't occurred in the US this time. You will know that I have been bearish on equities throughout much of this year and entirely wrong. I've expected the rapid rise in interest rates to lead to a slower economy, lower corporate profits, and falling equities. Well, that hasn't happened. The US equity market in particular has actually had a very strong year, and tech companies, which you would expect to be the most sensitive to changes in interest rates, in particular, have had an absolutely extraordinary year. So as 2023 draws to a close, there are perversely many reasons to be bullish. To be clear, I still think the US economy should slow, and that the outperformance of equities has been far in excess of the fundamentals, and that equities will struggle to maintain their momentum in 2024 because valuations are extremely stretched and expectations are extremely high. But lots of other commentators are bullish, so we'll go through reasons to be bullish as propounded by Yardeni Research. Well, first of all, interest rates are falling, finally, from their highs, and are likely to keep falling in 2024. Corporate bond yields are also falling and show no sign of expectations of corporate distress in the US. The US consumers still have spending power. They still have excess savings from the pandemic, and they now have real earnings growth, as earnings growth outstrips rapidly falling inflation. All of that means the US consumer has the resources to keep spending and actually grow their spending now. The US economy continues to create jobs, as reported earlier, and there are more job openings than unemployed people. So therefore, real wage growth is likely to continue as long as that is true. US households also have financial assets, so the wealth effect means that they will feel wealthy and be willing to spend. And this chart only goes up to Q3 and does not include the extraordinary rally in the S&P 500 and the Russell 2000 since then. The Russell 2000 is up over 20% since its lows in October. If this chart was updated, it would show US household net worth likely hitting an all-time high in nominal dollars. And that growth in wealth is broad-based. Pretty much every type of financial asset has continued to rise in value. And we know that onshoring is driving capital investment, which is behind the strength of the construction market. And that's thanks to the IRA and CHIPS Acts. As the boom in construction continues, so orders for construction machinery remain strong, supporting the economy. Falling interest rates should be a boon to the housing market and the housing construction, and the continued strength of the housing market shows continued strong demand for US new build homes. And if mortgage rates come down, presumably, then new home sales can only strengthen further, leading to a boom in construction. US corporate profits are high and rising, and they're forecast to grow again in 2024 and grow strongly. The AI revolution can be expected to lead to a boost in productivity and therefore in wealth creation. And certainly the markets believe that, and a lot of money is going into investment in AI. Now, the leading indicators are biased towards the manufacturing sector and therefore are misleading because over the last 30 years, the manufacturing sector in the US has continued to shrink, and therefore these leading indicators, which have been forecasting recession for many months, they are correct in forecasting a manufacturing recession, but the US economy is mainly services these days, and the grey line shows that GDP has been growing even when the leading indicators have been forecasting a recession. So these leading indicators appear increasingly irrelevant and should be ignored, according to Yardeni research. So, in summary, if we've reached the bottom of the cycle, there are lots of reasons to be bullish. But the question, as always, is how much is already in the price? And on to UK equities. Now, UK has been a terrible performer over the last decade. So this chart shows the performance of the S&P 500 in blue, the Euro Stoxx 600 in orange, and the FTSE 100 in green. The data going back as far as I can get from TradingView, which is April 2013. And over that period, the US has outperformed the UK to an absolutely astonishing degree. Investing in the FTSE 100, in fact, in the all share, has been very poor compared to investing either in Europe or the US. Now, the cause of that has been strong net outflows from US equities. In 1997, UK pensions and insurance companies owned 45% of UK listed shares. In 2003, they owned just 4.2%. So throughout that period, UK pension and insurance companies have been selling UK equities and buying overseas equities, which they expected to yield superior long-term returns. How much of that is a self-fulfilling prophecy? As a result, the UK equity market trades at a 50% discount to the US in terms of PE ratios and a 30% in terms of Germany. On a PE ratio basis, it's closest to the cheapest it's ever been relative to the rest of the world. So, how much of the underperformance has been caused by UK pension funds and insurers selling out and moving their money overseas? And now that they own only 4.2% of all listed shares, presumably the vast majority of that selling is over. And actually, if the UK stock market were to begin recovering, they might start moving some of that money back. So the UK market is certainly cheap by global standards. On a P ratio basis, is it time for the UK to start outperforming? You heard it here first. And on to other charts. Well, everyone's been talking about deglobalization. Frankly, deglobalization is just not happening. What is happening is that manufacturing is moving away from China towards other cheaper emerging markets such as India. So you can see that the top right-hand chart, manufacturing PMIs in India are stronger than anywhere else. China's not doing okay. Vietnam actually looks like it's in recession, as does Malaysia. But Mexico, Indonesia, and India are all still expanding. Global manufacturers seem to be actually doing okay. It's the US and EU and developed world manufacturers that are struggling. German industry, in particular, has been struggling because of the rise in energy bills, and its manufacturing sector has underperformed the rest of the EU. This chart shows government spending as a percentage of GDP before and after the pandemic. And everywhere, government spending as a percentage of GDP is higher than it was prior to the pandemic, particularly in the UK, actually, and Germany. So governments need to start cutting back and balancing their books and letting the private sector get on with it. The Bank of Japan has been talking about relaxing yield curve control in 2024. But if this chart is to be believed, they should be very careful what they wish for. So on the x-axis is a country's debt to GDP ratio, and Japan has a debt to GDP ratio of over 250%. And on the y-axis is the 10-year government bond yield. And what you'll see is that if Japanese 10-year bond yields were to move in line, to be in line with yields in the rest of the world, then the 10-year yield would have to move to around 4%. That would cause enormous financial losses in Japan and actually would likely lead to the bankruptcy of the government. So let's see whether they actually do allow yield curve control and how much Japanese bond yields rise. I would strongly suspect they won't let bond yields rise anywhere near as much as that, and therefore they won't be able to relax yield curve control. Okay, and on to good news. Well, this week, the US has announced this solar canal project in Arizona, whereby they cover the canal with solar panels. And because it's in Arizona, that generates electricity. The first phase of the project will cover 300 meters and generate 1 megawatt, which will be used by the local indigenous people. But also covering the canal with solar panels shades the canal and reduces evaporative water loss. And they estimate that if they covered all 4,000 miles of California's canals with solar panels, that would save 65 billion gallons of water a year. So win-win, generate electricity, reduce water loss. Now, onto equities. Well, it's been an absolutely extraordinary couple of weeks. Now, reminder, we missed the weekly last week because I was off hiking in the Lake District. So all the weekly changes refer to the change of the past 2 weeks. So in the past 2 weeks, the FTSE World Equity Index is up 3.5% and is closing the year up 18.5%. The All Share continues to be a terrible underperformer. It's up 2.9% over the past couple of weeks, but only up 3.4% year to date. Euro stocks is up 1.9% over the last couple of weeks, up 12.5% year to date. I'm absolutely mystified by the continued strength of the Eurozone. It's in recession, so corporate profits presumably aren't great, and interest rates have shot up from 0 to 4.5%, which should mechanically lead to a rise in equity yields and fall in valuations. That just hasn't happened. The Euro stocks has returned up 12.5% this year, despite very poor fundamentals. Mystifying. S&P 500 up 3.7% over the last 2 weeks, up 23.8% year to date. Most of that, of course, coming from the NASDAQ, which is up 4.6% over the last 2 weeks, up 43.3% year to date. Congratulations to everyone who held Nvidia, which is responsible for a big chunk of that. The Russell 2000 finally joined in. up an astonishing 8.9% over the last 2 weeks, up 15.5% year to date. So the US equity market is anticipating a big recovery in the economy in 2024. Has the usual seasonal rally just got a bit carried away this year? So this is the Hang Seng. It has failed to join in the global equity rally, up only 0.1% over the last 2 weeks, down 17% year to date. The equity market is saying that the Chinese economy is not doing well. Topics up 0.5% in the last 2 weeks, up 23.5% year to date. Bitcoin has had an extraordinary year, up another 0.9%, up 163% year to date, and that is despite Mr. Bankman-Fried and pretty much every other Bitcoin exchange in the world either being closed down or fined. Sterling had a good couple of weeks, up 1%, up 5% year to date. Over the past couple of weeks, the euro was up 2.3% versus the dollar is up 3% year to date. The dollar index fell 1.9% over the last 2 weeks, down 1.7% year to date. VIX, dead as a dodo. This is a long-term chart of VIX, right down towards its lows. Amazing. So there's a lot of uncertainty and volatility around everywhere except in options prices. Moving on to some charts, well, extreme greed is back, as evidenced by the rise in equity prices. And frankly, you have to think things were getting a bit out of control. From its lows on the 27th of October, the US equity market has rallied incredibly hard. The Russell 2000 is up the best part of 25%. The S&P 500 is up 16%. How much of the recovery, the anticipated recovery in 2024, is already discounted by the equity market? And obviously, over the last 3 weeks, there has been very little change in corporate earnings, and therefore the rise in the US equity indices has all been driven by PE ratio expansion, and Russell 2000 stocks are now looking pretty expensive. Dumb money confidence is back pretty much at its all-time highs. Now, historically, that has not necessarily led to a crash. If you pause, take a look, sometimes it leads to drawdowns, but at other times, no ill effects whatsoever. S&P earnings forecasts for 2024 have been resilient, but they haven't been growing. So there is a contradiction there between the strength of the equity market and the failure of 2024 earnings forecasts to rise. And the S&P 500 has just recorded 2 quarters of falling EBITDA and sales. But the equity market doesn't care. It's up now 8 weeks in a row, its longest running streak in 6 years. And the Dow Jones has hit a record high. The cyclically adjusted PE ratio for the S&P 500 is high. And frankly, I really expected it to fall with the rise in interest rates, but it hasn't. Now, does that mean the US equity market is just structurally overvalued, or there seems to be this trend upwards, which is mystifying? In order for the US equity market to make progress next year, earnings are going to have to rise, or the P ratios is going to have to keep on expanding. And the AI bubble continues to inflate. Investors keep on adding to their bets on tech and AI. At some stage, that will have to reverse. And stocks are expensive to cash. You can actually make over 3 times as much in the bank as you can on the dividend from the dividends on the S&P 500. But that hasn't stopped the market. And everywhere, markets are anticipating rising corporate earnings in 2024. Q4 has also seen very strong corporate buybacks in the US despite high financing costs. Again, very much against expectations, or my expectations. And moving on to commodities. Well, although equity markets have been going through the moon over the last couple of weeks, commodity markets have not joined them. So commodity markets are concerned about demand. Reminder, a lot of the commodities we cover, such as copper, there are long-term concerns about supply and supply being able to meet demand in the future. But in the short term, commodity prices are falling, suggesting that in the real world, there's not sufficient demand for existing supply and prices are falling. Pause and take a look at this. This is absolutely extraordinary. This is the amount of metals mined in the world in 2022, i.e. last year. So last year we mined 2.6 billion tons of iron ore. In it was contained 1.6 billion tons of iron. Go through, take a look. We mine extraordinary amounts of a lot of metals. We are not exploiting this planet in a sustainable manner. On to energy commodities. Well, Brent had a big bounce from its sell-off over the previous few weeks as markets thought the sell-off was overdone and became more optimistic about the coming year. So Brent was up 5%, taking it down to just minus 7.9% on the year. WTI up 4.1%, down 8.3% on the year. Some numbers specific to the oil market. Well, over the last 2 weeks, we've actually had inventory drawdowns in the US of quite large size, excluding the SPR, 7.3 million barrels. So over the last couple of weeks, the US oil market has been undersupplied. US crude production, however, grew by 200,000 barrels a day over the last few weeks to a new high of 13.3 million barrels. The US is a problem for OPEC. These higher oil prices allow it to keep on growing, and it's up 1.3 million barrels a day year to date. The Baker Hughes rig count fell 7. This is a really important chart for the outlook for oil demand. And what it shows is that India consumes vastly less oil than China does. If you look at China, in 2001, it was around the state of development that India is now. And as its economy grew over the next 22 years, its oil consumption almost trebled. And if the same were to happen to India, India's oil demand will also treble. And so that would mean that the oil market will be tight merely because of India's oil demand alone. Reminder, India is now the most populous nation in the world, and it's consuming only around a third as much oil as China does. One of the big lessons of 2023 was that sanctions just no longer seem to work. The US and the EU appear to have overplayed their hand, and there's now a well-established network of third parties that will export Russian oil around the world. India, in particular, has ended up taking all the oil that used to be supplied to the EU. And as the EU and the US have banned Russian oil from being transported in G7-owned tankers. So a shadow fleet has been set up to transport the oil. Russian seaborne oil exports rose again in December as storms in the Black Sea ended, allowing exports from there, and shows no sign of falling. Good news in the UK is, despite the current windfall tax, there are actually a lot of new developments potentially being given the green light. So in 2024, up to 14 new oil and gas fields in the UK could be given the green light. Fingers crossed. Frankly, we use a lot of oil. It is much more environmentally friendly to exploit our own and only transport it a few miles through pipelines than is to get it from halfway around the world. So moving on to natural gas. Well, natural gas prices continue to decline. That is great news for European consumers. Down, Dutch natural gas prices are down 17% over the last couple of weeks, down 55% year to date. That feeds directly through to disinflation. UK down 16%, down 52% year to date. Marvelous. US natural gas was up 0.8% in the last couple of weeks, still down 41% year to date. Coal drifting off. The US has agreed to ban its coal usage as part of COP28, price down 63%. Uranium still on a tear, up 6%, up 77% year to date. Okay, on to industrial metals. So aluminium had a great couple of weeks, up 7.6%, but still down 2.1% year to date. Cobalt continues to drift off, down 10.9% over the last 2 weeks, down 44% year to date. The chart is over the last 10 years, and it's at its lows. Copper up 3.4%, but only up 2.4% year to date. Reminder, the energy transition is going to need a hell of a lot of copper. In 2020, we mined 28.8 million tons. Estimates are that in 2040, we're going to need 55 million tons. Where are we going to get it from? The copper market should be structurally tight in the coming years. Chromium up 0.8% over the last couple of weeks, down 7% year to date. It's a long-term chart. Iron ore still rising, up 2.2%, up an amazing 18% year to date. And that is all down to Chinese smelter demand. Lithium still drifting off. It's a long-term chart. It's down 82% this year alone. Neodymium down another 5%, down 41% year to date. Nickel up 2.2% on the week, but still down 44% year to date. This is a long-term chart. Tin up 2.5%, up 1.6% year to date. Again, long-term chart. It's prone to extraordinary spikes, tin. Ferrovanadium actually ticked up 4%, but still down 28% year to date. Zinc also bounced up 7.4%, down 12.3% year to date. So a lot of the industrial metals actually joining in to the equity market rally on optimism for 2024 and interest rate cuts. Of the precious metals, gold rose 1.2%, decent year, up 12.6%. But in adjusting for inflation, gold remains 20% below its 1980 peak. Gold is a volatile investment. Silver up 1.7%, only up 1.1% year to date. And silver is also an industrial metal in short supply, much needed by the solar industry. Platinum up 6.4%, down 9.3% year to date, but at least them showing some signs of a pickup. Rhodium, just dead as a dodo, down 0.3% on the week, down 64% year to date. This is a long-term chart. It is worth a fraction, about 15% of what it was back in its heyday in 2021, down 85% from then. Palladium has an extraordinary week, up 23% over the last 2 weeks, but still down a third over the course of the year. Again, a long-term chart. And finally, onto rates. Well, the falls in inflation and Jerome Powell's speech, in which he stated that he would be cutting interest rates in advance of the US inflation hitting 2% and forecasting that there would be 3 rate cuts next year, have all led to a big fall in global bond yields. Now, the UK yield curve shifted decisively lower, and that was great for me. The same in the US. Now, if we compare the UK and US, UK yields are now actually substantially lower in the mid part of the curve than the US. So bond investors are willing to pay a premium to the US for buying UK bonds. Now, reminder, the UK budget deficit is mandated to be on a sustainable path by the Office of Budget Responsibility. In the US, that is not the case. Now, you can argue about whether the governments will actually cleave to those OBR forecasts, but at least the UK does have a fiscal discipline mechanism, whereas the US does not. And so we talked earlier, we have talked throughout the year about the bond vigilantes. Are the bond vigilantes therefore punishing the US for the fact that the US fiscal deficit does not appear to be in control? Reminder, QT continues in the Eurozone, tightening financial conditions. The ECB now only owns bonds equivalent to 50% of Eurozone GDP. That's absolutely extraordinary number. The Fed only owns 28%. The Bank of Japan owns 128%. And over the course of the last few weeks, inflation break-evens have been falling and remain well anchored. And this chart shows that US private citizens own more US treasuries than foreigners now. So in answer to the question, who's going to fund the US deficit? Answer, its own citizens in search of yield. And if you look at global central banks, more of them are now cutting rates than hiking. So the cycle in monetary policy has definitely turned. And that should be good for bonds. And this chart shows that everywhere fiscal deficits remain very high, which means lots of bond issuance that will need to be financed. Inflation needs to come down, interest rates need to come down in order for that to occur. But the rise in bond prices has sucked in the speculators, and CTAs buy on momentum. Rising bond prices have got momentum, and so now moved from speculators being net short treasuries to being net long. Moving on to the rates themselves, this is the UK 2-year, now at 4%. It was at 5.5% in July. UK interest rate expectations moving decisively lower. UK 10-year at 3.5%, 30 at 4.07%, all of them coming down sharply. US 10-year at 3.9%, well down from its peak at 5% a few months ago, and barely changed on the year. German 10-year, well down on the year and have fallen massively over the last 3 months. The budget enforcement mechanism in the EU suggests that fiscal discipline will prevail, that the EU governments will not be joining the UK and US in having very high fiscal deficits, and that actually should mean Eurozone inflation will return to being very low, but at the expense of its recovery also being more difficult. Italian 10-year collapsing, 3.56%. Greek collapsing. The Greek 10-year is now substantially below the 10-year yield on UK or US 10-year bonds. So the markets think the Greek 10 years are a much better bet than either UK or US bonds of the same duration. Concluding comments. Well, first of all, Merry Christmas. It has been a very difficult year. I hope you've done better than me, which frankly is not difficult. And we will be back in the new year with a couple of special podcasts on what we learnt during the year and highlights from the podcasts during the year. Now, in summary, it's been an absolutely extraordinary year, which is coming to a close with an extraordinary risk-on rally. Equity markets have throughout the year defied the rise in base rates and are now anticipating rate cuts. It seems that we are rapidly returning to a world in which no financial assets represent good value. Everything is expensive. You remember pre-pandemic how bond yields, you could not get positive yielding bonds. Well, it looks like we're heading back there fast, and the yields on equities, particularly US equities, are very poor. Everything is expensive once again. Inflation is coming down rapidly. That's great news, but the EU is in recession. Inflation is falling. The latest budget discipline pact means there's a danger of the EU returning to a low growth, low inflation equilibrium that it had pre-pandemic. Everywhere the market is anticipating interest rate cuts in 2024, and we very much concur. Inflation everywhere is falling rapidly towards target, and if you look at the last 3-month or 6-month annualized, it is very close to target. Risks still remain, though, for the US economy, which has been extraordinarily resilient in 2024. The fiscal impulse will be negative next year. The positive impulse from private sector manufacturing investment has likely peaked and will be at least less positive next year. And US consumers are rapidly running out of excess savings from the pandemic. So the markets are anticipating that the US will cut interest rates and earnings will grow as the economy in the US does fine. But there are still dangers. And finally, on to me. Well, I've had a great couple of weeks, actually, up 9.5%. And that puts me actually only down 1.5% year to date, which, frankly, when I was down 22% earlier in the year, I could not have believed I would recover so well. Ultimately, I stuck to my guns, and markets have come my way. It's still obviously not been a great year, and equity markets have absolutely defied my expectations, as has the US economy. I continue to believe that bonds will be a better investment than equities going forwards, but that wasn't the case in 2023. Now, this is T68, one of the long duration UK gilts that I own, and at its worst, it was down at 55. I started buying it at 100. It now has a real yield of 0.72%, and it expects UK inflation to be 3.2%. I expect both of those to fall further in 2024. Now, if we look at the long-term performance of T68, well, really, this recent rise is just a blip. Back in 2013, the price of T68 was 105, and UK inflation is coming down rapidly. The economy is slow, and the effect of higher interest rates have still not fully been felt. I expect inflation to keep on falling and the Bank of England to have to cut interest rates hard. At that point, I think I at least get my money back. And finally, during the week, a company that we have previously discussed, Harbour Energy, acquired the production assets of Wintershall, which will add 317,000 barrels a day of production. The market really liked it, and there's been a lot of discussion of the deal on our Discord. If you're not a member, please join us. That's it. Merry Christmas. Go away, eat some mince pies, and try not to think about the market. It's been an absolutely extraordinary and stressful year, and we will be back next year to provide week-by-week commentary, we hope. In the meantime, please can you press like and subscribe to the channel, and it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.